Hello, guys. This is the fourth efficiency ratio. Okay, we are going to talk about giving ratio. That's the first. Okay, we need to identify that giving ratio is very important. Why? Because this specific formula is going to help us or to help the enterprise to measure the extent which an organization is going to be financed by external sources of finance. That's kind of the main purpose. It is loan capital that is going to be expressed as a percentage of the enterprise total capital employed. Okay, this is the main purpose of this ratio. The given ratio, as I said before, is going to help the enterprise to calculate the extent to which the capital employed to this enterprise is going to be financed from loan capital. Okay, remember, loan capital is a long-term liability, the business, while capital employed is going to include, as I said, loan capital, share capital, and retained profit. Okay? Picture this. Imagine that you are working and you are the CEO from a manufacturing industry and you need to get or renew a machinery. Okay? And this machinery is going to be so expensive. Okay? And that's why you are going to use the ratio to measure if you are going to have this opportunity to analyze the capital employed in order to finance, no, to external sources to acquire this machinery, okay? And the formula is given to, in your formula, remember, is going to be the loan capitals over capital employed times 100%. In this case, the result that you're going to get to calculate is to get a percentage. I'm going to show you an example here. A business, maybe this business could be Pelican, no? Has a loan of $10 million with a capital employed, remember, about 25 million. What is the gearing ratio? Remember, the capability that an enterprise is going to have to be financed by the external sources, just as a reminder, okay? So, in order to apply the formula, just we substitute first loan capitals over capital employed. Loan capitals, $10 million over capital employed. In this case, 10 million over 25 million times 100. In order to get a percentage, we already get, with this example, 40%. That means that the gearing ratio is 40%, which means that 2/5 of the capital requirements of the enterprise come from long-term loans. A high gearing ratio could be viewed as risky, remember, okay, who may be reluctant to lend to enterprise in such a situation due to the large debt burden, okay? If we got more, it's going to be riskier from financiers, okay? That means that the capital employed is not going to be well enough to then to provide us this loan capital, okay? But in this case, it's okay. So, Tips to improve gearing ratio. A business may seek alternative sources of funding, not necessarily loan-related, okay? Because loan-related means long-term, for example, internal sources of finance. Do you remember? Personal funds, okay? Savings that the enterprise got, other variations or varieties of generating incomes, no? Maybe the enterprise diversified its sources, generating alliances. No, this is the use of gearing ratio, guys. Should it be the last? Okay, the last to take in account, but big scale enterprises, multinational enterprises, as I said, Pelican, they already are going to need to get loan capital, okay, because the machinery that they are going to use is going to be really expensive. And an alternative, could it be better to get this loan capital? Okay, this is the gearing ratio. And with this, we already complete the whole ratios, okay? Just as a conclusion, it's not uncommon for businesses to rely on using these external sources of finance, such as medium to long-term loans, to fund its operations, growth, or evolution. However, debts need to be managed efficiently. That's the most important. As an efficiency ratio, this ratio, the gearing ratio, indicates the degree of financial risk that a business can afford to take by measuring the extent to which this enterprise capital employed is financed by external borrowing. No, talking about the Pelicans example. First, enterprises with a high gearing ratio are usually at risk should interest rates in the economies increase. Why? Because higher interest rates increase the cost of borrowing. And first, with existing loans, because maybe in the case of Pelican that I said to you, this loan is not the only one that they have. So that's why are likely to have to pay higher interest repayments to the lender. That's why, essentially, this is because businesses with a high gearing ratio are generally extremely dependent on borrowing, so incur long-term debts. So that's very important, okay? As a conclusion, trying to use or rely more on internal sources of finance. As I was talking to you, retain profits or maybe share capital instead of external sources of finance. Why? Because this incurs in interest charges. Okay? Thank you very much.